This episode of Eye On Innovators takes a look at an important industry analyst and why we believe his view of WeCommerce is flawed. There was huge news this month for WeCommerce as TD Bank initiated research on the company. The analyst believes the M&A potential in the Shopify app ecosystem is huge. We agree. The analyst believes WE is a buy. We agree there too. The analyst believes the M&A pipeline for We is already built into the valuation, and that's where they are wrong. WeCommerce estimates a $100 million ARR opportunity in the M&A pipeline, and none of that is factored into today's price. The basis of their hold rating is threefold. 1. Growth is priced in. 2. Multiple is too high based on last year's revenue. 3. Management experience. Here's why we believe this is important and where TD's analyst misframes WeCommerce. He positions WeCommerce's valuation based on trailing 12-month revenues, which is a fairly standard approach for many projections, but an antiquated approach for a high-growth tech company. We's stated aim is to aggressively acquire strategic businesses to complement their current offerings and to cross-sell to merchants. Basing their valuation on what the company did before they were public and before amassing a massive $60 million acquisition war chest shows a misunderstanding of the company's roadmap. The analyst claims that 1/3 of the trailing 12-month is currently recurring, but that's not the full story. The beauty of WeCommerce is the flywheel effect, as merchants get hooked through one product, and then as their needs grow, are introduced to We's full suite of offerings. The recurring revenue is the floor, not the ceiling. TD says the market has already priced in future acquisitions. But judging by their tables, the numbers don't add up. Comparable companies in the space trade at 35x revenue. So how are the potential acquisitions of $100 million of annual recurring revenue in the pipeline that gets priced at, say, 30x for SaaS companies, already priced in? 100 million ARR at 30x adds $3 billion market cap to WeCommerce. The current market cap is less than $1 billion. In our opinion, future acquisitions have not been priced in. This is where Eye On Innovators believes TD's analysis really breaks down. After WeCommerce revenue grew 22% in 2019 to 40% in 2020, the analyst projects revenue growth will decelerate to 31% in 2021 and 21% in 2022. Say what? At a time when more businesses than ever are moving online and more companies will need WeCommerce's offerings, it's staggering to forecast a high-growth software company with a war chest of cash and an outstanding advisory board and team will see double-digit revenue deceleration over the next 2 years. TD tries to justify their hold rating based on the fact that We leadership doesn't have much experience, which is demonstrably false. Co-founders Andrew Wilkinson and Chris Sparling have been building the business for nearly 15 years with a great track record in tech and have been part of the Shopify App Store ecosystem since its inception over a decade ago. If anyone knows the space, it's them. And don't forget that Bill Ackman, who knows a thing or two about making money, is a major shareholder. The report makes reference to Lightspeed, but as you see here, TD has been consistently behind the stock moves and upgrading. That's a pattern of misunderstanding growth companies and being preoccupied with looking in the rearview mirror. We don't agree with TD's price target. When looking for expertise in identifying the next big companies, do you want someone constantly looking at what was, or someone focused on what will be? Thanks for watching the latest Eye On Innovators. Please like and comment, and remember to subscribe to our channel for more investment analysis and insight.